Welcome to the Techno Fundamental Report for August the 15th. Incalculable. You know, back in 1995, I met a money manager out of Akron, Ohio, named Jim. And he basically looked at what I was doing, which at the time I was using a very conservative blue chip strategy. And he said, Andy, you've got to look for things that are incalculatable. Now, these are hard to find. They're very rare. But if you really think about the market, if you take a company, let's say like General Motors, you know, the market knows pretty much within the zip code how many cars they're going to build per year. And they know what the profit margin is per car. So it's very calculatable. And as a result, there's not a lot of speculation. Therefore, prices are pretty baked into the cake. But if you look at a story, something like an Apple, you know, back in 2003 when the iPhone came out. Prior to that, they had, you know, computers and they had the iPod. You know, who would have known that they had this magnificent new device? So incalculable becomes new concepts. You've got to have companies that have new things going on. Now, we all know that stocks like trees don't grow to the sky. So what happens is, when you get into these very incalculable deals that are very prolific in the initial stages, it becomes a crowded trade because everybody starts doing the calculations, and then it becomes calculatable. And so, you know, extremely crowded trades really work. Extremely crowded trades rarely work extremely well. So it's kind of like find something good, get there before the next guy. Now, as we get into where we are today, you know, we're kind of dealing with a very massive chess game here with the market. Three-dimensional chess here that Spock played on Star Trek was always so complicated. The market is complicated, no doubt about it. Now, what's tricky here is, and if we look at these dates, here's '01, that's the dot-com bust. Here's '08, the financial crisis. So if you look through all these dates, and these were the largest changes in the NASDAQ for those days. So like back in 2001, one day was up 14%. So what happens is you get these dead cat bounces in these bear markets, because people really they have a fear of missing out. So they'll see these massive up moves and figure that it's a reversal of trend. So let's look at this. Look, the primary trend is very important. We talk about this almost every week. This is the primary trend of the NASDAQ during the 2000 dot-com bust. You can see here that the primary trend was down. Now also I have the 200-day moving average here, and this index broke below that 200-day and stayed below that 200-day. So when the primary trend is down, you know, very few things are going to work. I mean, you're basically in a bear market. Now today, if we look at where the market is, we have right here, I have the S&P and also have the NASDAQ. The primary trend is up. So we're in a completely different situation here, and we should be aware that as long as the primary trend is up, usually these pullbacks that we're going to get in the market, like we just got recently here, they're buyable. And so you just need to be aware, though, that there's another complicated factor is that usually when you get a drop like this, now this is the NASDAQ as of yesterday, when you get a drop like this, usually it is a changing of the guard, meaning that some of the stocks that led this or were the leadership of this up move are the ones that are failing because they've become calculatable and everybody's starting to move on to something else. So let's kind of review real quickly. Last week we talked about a follow-through day, which we got. You can see here that, you know, on this particular day here, so here's the drop, here's the bottom of the NASDAQ down move. Actually got down to the 200-day moving average but held. Now remember, the primary trend is up. So we then count at least 4 days from when we start to get what we call a rally attempt. Well, 1, 2, 3, here's the 4th day, here's the 5th day, and then boom, we get the follow-through day, which was up over 2%, and volume on that day was higher than the previous day. So this is a follow-through day. Now, one thing to understand about follow-through days is that every bull market has started with a follow-through day, but not every follow-through day works because there's not always going to be a bull market. Now, the only thing I don't like about this pattern is this is what you call a wedging formation or a V bottom, okay? Most bottoms tend to be W bottoms, so you'll get a double test and you retest the lows. You might actually go a little bit lower than that. But what I'm saying is that we don't want to get too wild and crazy here. Even though we've got the follow-through day, we would like to see this kind of confirmed by getting another follow-through day. And also, don't forget here, the moving average have gone into a death cross. So this has been a pretty severe downturn. I just don't think it's going to get resolved extremely quickly. So as we look at the other indexes, you can see the same pattern. We came down aggressively on the mid caps. We're now in a wedging pattern. We did get a follow-through day here. It wasn't as powerful as the NASDAQ though. Here's the New York Stock Exchange. You can see here breaking out above here. This is a group. The New York Stock Exchange is a lot of very large cap, a lot of consumer staples, things like that. But it's definitely showing more strength than most of the indexes. Here's the small caps, same pattern. We did not get a follow-through day, though, on the small caps, which is somewhat of a warning. I really would prefer that the small caps actually were leading for a while, but they're not leading right now. Here's the S&P 500, same pattern, wedging pattern. We did get a follow-through day right here. So let's just hope that this stabilizes. Now, one thing I want to mention here is that if the market or the index breaks down below the low of that follow-through day, and that means that the follow-through day is negated and you got to start the count all over again. But so far, so good. They seem to be holding. Now, here's the equally weighted S&P 500. The RSP, same pattern, did not get a follow-through day. So again, the market needs to broaden out, and this index is designed to kind of help us with that. However, the good news, I think, is that interest rates are really starting to stabilize here. Here's the 30-year mortgage. Just yesterday, it was announced that refinancings are hitting record levels as the mortgage rates come down. So we're starting to see a definite downtrend in interest rates. Here's our power index. Now remember, what we're doing is we're measuring the rate of change of interest rates over the last 125 trading days. So you can see here, the power index is basically saying interest rates are in a downtrend. So hopefully the Fed cuts in September and we get interest rates down even further. Now the volatility index, I just wanted to mention it. We got on the drop that we got a tremendous spike in the volatility index. However, it has come back down into somewhat normal levels now. So if you have any questions, please let me know. Thank you very much.